back to another video. So somebody recently asked me to ideally make a lecture in regards to SMT and how you wanna use how I would personally go about it, right, in regards to using SMT. Personally, I do not really focus much on SMT, right? It's I don't need it for to take a trade, right? I just personally feel as if yeah, it's not really something I require. You understand? But it's usually within footprints of what I'm looking for. Meaning, for SMT to ideally happen, right, it needs to be reacting of something, some way, right? When two correlated asset classes create SMT, so when one sweeps liquidity and the other one fails to, right? But reversals will ideally be present or behave of a specific key area in which will be influential for price reversing, right? This video should be ideally quick because there's not really any, I would say, complications in regards to SMT, right? It shouldn't really be that complicated, right? But you need to blend in a lot of factors like the true session opens and the true opens, right? It needs to be forming within specific areas, key areas like previous um, dynamic premium and dynamic discount. You understand? So those are things you'll ideally always focus on in regards to precision and where it should ideally form, right? SMT is ideally fractal, just like every other concept, meaning where it forms and where you want to see it form will be ideally based on how you trade and what you specifically look for, right? We have cycles like this, right? I'm explaining this from a base level, right? So that everybody can incorporate this into their trading, no matter what type of a trader they are in regards to long term or short term, right? There's quarterly cycles, right? These quarterly cycles are basically universal. It can be a microcycle, a nanocycle, a weekly cycle, or even a yearly cycle, right? It is ideally universal. When you're looking for SMT, right? Let me do it like this. You are always going to be looking to see it form between two cycles, right? Between two cycles, meaning it's either going to form between, excuse me. It's either going to form between Q2 and Q3, right? Or it is going to form within Q3 or Q4, or it's going to form within Q1 or Q2, or it's going to form between Q4 and Q1, right? But where you want to see it form will be ideally dependent on where you trade, right? If you're a person who trades sessions, right, and you trade the New York session, right, that means you would ideally expect your SMT to form within Q3 and London because now you're trading within Q3. If you're trading within Q2, you want it to form between Asia and London, right? That's where you want to see higher prices, right? So it is completely universal to where you want to see it form, right? And if you want to incorporate this with red folder news events, right? The best way to incorporate or anticipate where SMT should be forming in regards to or in correlation with red folder news events is going to be where volume is, right? Pretty much I've been saying this for, I'd say, forever in regards to all these things, right? They only work when they're in agreement with volume, right? Like this. Okay. We can say we are having red folder news events right here within Q3, right? The time would be ideally 8:30 news, right? Okay, that should be good, right? That is ideally where you anticipate SMT forming. The session where you're gonna have volume, right? That's where you'd anticipate your SMT to form. Rarely are you ever gonna get something like this, right? That means if you get SMT between the previous cycles that you ideally not trading and you're trading within Q3, right? Your SMT would have to be within the internal range right here, which is ideally in agreement with the overall order flow of the day. Meaning, when you have red folder news events like this and you're still looking for higher prices, right? Your SMT would have to be forming within Q3, but within internal cycles within Q3, right? In this case, we can say it is like this. Let's do it like this. Something like this. Okay, trying to copy this. It would be ideally something like this, which is SMT. This color is not as clear. Let me make it black. Like this, between Q1 and Q2 of Q3, right? That's when it would ideally happen with an internal price data range. That's why I'm saying SMT is ideally fractal. It's gonna happen everywhere, right? But you just need to correlate it with your model, right? So that's pretty much why I personally say I don't need this to trade, right? Because usually, let's say I'm trading this given asset class right here, and I'm trading it within Q2 like this, right? I can just incorporate a time-based PD array that forms here, right? And use this for price to react even at this given time right here, without even me concerning myself of has price swept this liquidity. You understand? I don't need SMT, but this is ideally the most simplest and effective way you'd wanna identify SMT, right? You do not, right, ever skip cycles when you want to identify SMT, right? Because once you begin to do it like that, you'll be doing a lot of guessing, meaning you never want to see something like this, whereby now you say this and make it like this, whereby now you're saying we got SMT between Q1 and Q3 and Q1 and Q2. This is completely incorrect. This would not be regarded as SMT, right? You want to use executive cycles, the current cycle you're in and the one before it. You understand? Let me further explain in regards to how you can trust SMT, right? And how you can ideally trade without it. Okay. Gonna open NASDAQ on this one right here. Okay. I am gonna disable this and this. Then I'll copy this. Okay, perfect. Okay, if you me do this. Okay. If you look at this given price range right here, in fact, let me only use this just to make everything simpler, right? If you look at this given price range right here, right, you'll notice that we have this low on US 30, right? This is the lowest low, and it ideally formed where? Within Q3, right? Just right after sweeping this low right here, right? Which is formed where? Within Q2, right? You don't want to be referring to any other lows, even if this low right here could have been swept here and then here it wasn't. You don't want to refer far back like that. You just want to refer to the current quarter you were in and the previous one's liquidity, right? And how do you identify its liquidity? You just mark out the range, right? The full range, right? And the range is high and low. That's your true liquidity, right? The range is high and low. Same as right here within Q3, right? The range high and the range low. That is time-based liquidity for the specific cycle. You understand? One thing you also need to understand, there's either going to be two ways in which this low is going to ideally initiate reversals, right? These are going to be two factors that you're always going to have to consider, right? That means price within this current chart, this asset class, right, is either going to be reversing. Let me do this just so we don't get confused. Right now, right? The only thing we should be focused on is these two cycles right here. 1, 2. Forget everything else. Meaning the only line of focus right now in regards to data will be this. Let me make it white. Right. This is the only data range that we are focused on, right? And then the exact same thing has to be identified here. This is the only data range that we are ideally going to be focused on. Everything else you want to admit, right? Forget it's even in the chart, right? This is your overlying given focus, right? When SMT is forming, right, this reversal is either going to be from an external PDRA, which is outside the two cycles ranges, right? And this is usually the most, I'd say, traditional way in regards to how you want to see price react, right? Higher time frame, PDRA, right? Or we can just say PDRA, because sometimes it can even be within the current time frame, right? That is the first way to identify if price is going to hold within this reversal area, right? The other thing would be within the internal data range, meaning what's driving price to reverse here on US 30 may not be a PDRA that formed within this specific level on US 30, right? But maybe what? One that formed within NASDAQ, the one that failed to draw to ideally give the low, meaning this could be something like this, right? It's initiating reversals within this key area of a PDRA that formed within the range, meaning this is where SMTA comes in, right? Okay, let me add in a few more additions. Okay. Within this Q2 and Q3 range, right? And this one too, right? You'll notice the low formed where? Within Q3, right? The low formed within Q3. But here, it failed, right? Failed to sweep this low, right? Meaning something here was holding price back from going any lower, right? Within Q3. So, if I mark out Q3 like this and refer back to the previous range, right? It's always going to be the first one that you have to focus on, right? One thing you will notice, right? I'm pretty sure you might be catching up or catching on. We have this right here, which is okay. Q3 time based fair value gap, right? A Q3 time based fair value gap, which is ideally within the inner range time based range array, right? When one range opens, it draws back into the previous one and then reacts off it. The rules are, as long as price does not close below this imbalance, you are anticipating or expecting this given imbalance to be supporting higher prices, right? If price closes below it, then for me, it can tend to be neutral, right? On higher time frame, I omit it. It begins to support lower prices. But on smaller time frames like the 5 minutes, right, I can allow price to close just right below it, right? I can allow price to close just right below it. But usually, I would incorporate order blocks. I don't use order blocks to trade, right? I only use them to support my narrative in regards to where I want to see price going. You understand? And they always have to be time based, meaning order blocks for me, right? They are down close candles and the lowest down close candles within a time based range, right? If that makes sense, right? For example, right here, right? This range is within Q1, right? That means my order blocks would have to be within here. And one thing you will notice is we have this right here. This executive down close candles, this one. You can combine them into both because they're within the range, right? These are the lowest down close candles within the time-based range array, the Q1 time-based range array. So for me, that is a time-based order block, right? Supporting higher prices. And the rules are it should never, ever close below the mean threshold, right? The mean threshold is the midpoint of an order block, right? You can outline it using the bodies or the wicks. Either way, it's a preference, right? Whichever one is fine, right? But for me, I don't just use order blocks like this, right? I prefer them to have imbalances in correlation to them, meaning above it, there should be a time-based PD array, which is an imbalance. That's how I can trust and incorporate it. You understand? That's the only way. If you want to use them for trades, executions, just make sure the easiest ones that will be highly efficient and effective, right, will be the ones that have imbalances within them, right? Hopefully that makes sense, right? Okay, let me remove this and then we get back to what we were saying. So within this Q3 time-based range array, price draws into the range, does not close below the imbalance, right? Then begins to react higher, right? At exactly the exact same time that happens, okay, price, right, on US 30 begins to distribute higher, right? Meaning this is SMTA, right? If I can do this, I'm gonna say move forward like this. This is SMTA, meaning this imbalance right here, right, is ideally influencing price reacting right here, right? If I am to explain this in the simplest of ways, right, it's dynamically transferring itself to the sister asset class, which is something like this. Hopefully it makes sense, right? Hopefully it's making sense like this, right? This is basically what SMTA is, right? When one touches an imbalance and the other one has no imbalance, or it doesn't even touch its relative imbalance, right? But one does, but they both react off it, right? That's basically what you're considering in regards to SMTA, right? That's also how you measure volume, you know. This is basically how you want to consider reversals, right? Sometimes, right, it may even be scary, especially when you are looking to see price go lower like this, right? There's two ways in which you can get involved in this. You can either trade the one that's currently reacting off the imbalance, which would be Nasdaq, meaning right there, as soon as price touches the range, you'd go long, right? You go long seeking higher prices, which would be what? Buy side liquidity, which is from most definitely the previous session, which would be that high right there, right? And the price continues going higher, right? Or as soon as this can tend to be very scary, especially when you are still new to the concepts, right? Or you have not seen this play out enough times, right? As soon as Nasdaq, right, draws into that imbalance and touches it, you immediately go long, right, on US30, right? But the tricky part will be, where can I place my stop, right? Where can I place my stop? A little way I personally approach it in regards to this whole entire concept, right? I would go long, right? I can place my stop. Maybe it can be something like this. Like this, right? But I'm not risking this given amount. I'm just letting price breathe, right? Usually, if I'm seeing large candlesticks ideally go against me, I will immediately kill the trade, right? But as soon as I go long here, right, you want to place your stop at a suitable area in regards to your contracts, right? That's going to be completely unique to you, right? That's why I keep saying trade the one that touches the imbalance, not the one that doesn't, because you don't really know how far price is going to go against you, right? But if you're trading the one that doesn't, that means your main focus is you watching to see this PDRA get respected on Nasdaq, meaning as much as I'm long right here, right? Let me do it like this. When does it get touched to get perfect? I don't like bar replay, by the way, but just for annotation purposes, we'll use it. Right, let me even remove this. Okay. This candle, right, begins the Q3 range. This is where you'd be going long, right, on Nasdaq. But if you are a US30 trader, that's the exact same area in which you'd be going long, right? On Nasdaq, you'd want to place your stop at the low like this, right? Usually, though I place my stop at the relative equal low, that is not where my true stop is, right? My true stop is this PDRA being respected or not, right? Because I'm allowing price to wick around within it, but I will never allow price to close below it, right? And if it does, I focus on this down close candle right here. I will not allow price to go anywhere lower than that and close below it. Then I can manually kill the trade right there, in regards to right there, right? But this case, on US30, you'd have to figure out an area in which is suitable for you to place your stop at, right? Your drawn liquidity would be relative equal highs or clear buy side, right? I don't really concern myself if they're equal or not, right? I don't really concern myself, but that's what you would be ideally looking for, like this. If I'm bullish on US 30, I'm also focusing on NASDAQ, because if NASDAQ reaches the target, right, chances are US 30 won't. You understand? Right now, I just went long on US 30 off an imbalance that formed on NASDAQ. This is your workflow in regards to which one are you trading, right? Okay. Then you want to see immediate reaction at the exact same time from both asset classes, right? You can even take partials as you see price goes back, because you need to feed yourself. You understand? Then just pay very close attention. Okay. Fortunately, in this case, they both hit TP. But if one had hit the other one first, you can manually close the other trade, right? This is how you catch reversals. This is how you know where SMT is going to form, right? I just don't really concern myself much with it, because I'm usually not trading this. I'm trading this. You understand? I don't really care about where highs and lows are going to form, right? I just want to capitalize on the move, right? Me entering here or me entering here does not mean this entry is better than this, right? It's very easy to anticipate reversals in regards to this logic and correlations of SMT, but you just need to trade the easier one. And in this case, it would be this one, right? But yeah, with that being said, guys, hopefully you guys learned something new. Hopefully I was able to answer your question in regards to SMT, right? Simple. Just use 2 executive quarters, right? If you don't know what's going to drive price to reverse here, focus on the sisters, NASDAQ, ES, and Russell, right? It's that simple. But yeah, guys, with that being said, I don't even know how long this video was, but with that being said, hopefully everybody has a good day and a good weekend. You guys stay blessed. Bye.